Hello, my name is Steve Feiss, and I'm with Etico Partners. I'm the firm's Managing Director of Fixed Income, and today I would like to address two of the most popular questions being asked by professional money managers. First off, how high can rates go before they matter? Secondly, are break-even inflation rates suggesting the Fed is behind the curve and rate hikes are coming sooner rather than later? To answer the second question, we'll need to answer the first question, so let's jump right in. First and foremost, I'll start with my conclusion in case the rest of what I say puts you to sleep. The 10-year Treasury is currently yielding approximately 1.3%. It's my view that yields, having nearly quadrupled from historic pandemic lows of nearly 30 basis points about a year ago, are now approaching the top of their new trading range. Let's call it another 10 to 20 basis points, so 1.4 to 1.5%. Along with interesting, psychologically important round numbers, we can look back to recent history of the yield curve, a popular tool of the pros, and see that during the last cycle, back in 2016, the 2-year to 10-year spread got as wide as about 140 basis points. Based on that, and with the current Fed commitment to keep rates low, then the 2-year is currently about 10 basis points, so mathematically 10s to 1.5% makes some sense. Now, from a more macro perspective, I should state I'm a big fan of thinking that in life, as in markets, there are nothing without consequences. Higher rates then make perfect sense when you consider them as a reflexive mechanism to the new administration's spending plans. 1.9 trillion replacement of incomes, followed by another 3 trillion infrastructure, so net new issuance, the amount of new Treasury securities needed for funding all of these fiscal follies will be orders of magnitude, think in the trillions, and so higher rates makes perfect sense. At the same time, we must consider a few things as rates rise. These higher rates are becoming more competitive to a whole host of potential investors for all different reasons. Here are 5 things to consider. First, the 10-year yield is now just 14 basis points less than the dividend yield of the S&P, a function of higher stock prices and higher U.S. Treasury yields combining to make a very compelling case for some portfolio de-risking. Consider it a rebalancing story around month and quarter end rapidly approaching. Second, higher U.S. Treasury yields are now more competitive on a foreign exchange hedged basis. A large portion of the world is currently operating with a negative rates regime. The Eurozone, Japan, and perhaps soon to be in the United Kingdom, all making positively yielding Treasury debt attractive. Third is demographics. As the population gets older and closer to retirement, they're going to need something to fill that income void. Fixed income securities now offer a somewhat higher yield. Fourth, the supply of Treasuries creates its own demand. As passive investing has grown, so too has the amount indexed to fixed income, and these indices now have a larger universe to mimic by mandate. And so, as more treasuries are created to fund all these stimulus endeavors, income replacement, infrastructure, these index funds will be forced buyers. Finally, higher rates have consequences. In just the past week, Tuesday, February 16th, saw the single biggest one-day increase in the 30-year yield, up about 8 basis points, since the Georgia elections. The day after, we were up 11 basis points. It's worth noting, stocks have been down 4 days in a row, and mortgage demand is showing signs of stress. Mortgage application volumes were down about 5% in the past week, and this as the 30-year fixed mortgage rate increased 2 basis points from 296 up to 298. 298, that's up nearly 80 basis points from the same week just 1 year ago. So higher rates already matter, and stocks may be at a pause or an inflection point, and the red-hot real estate market may begin to feel the pinch. This makes fundamental sense, given how both stocks and real estate have grown increasingly dependent upon low rates, and, in my estimation, this dependence has increased while at lower nominal levels. So it won't take as big of a move in both size and scope as it has in the past. 2013 taper tantrum, for example, to cause some concern. Now, in as far as the second question goes, relating specifically to inflation, are break-even inflation rates suggesting the Fed is behind the curve and rate hikes are going to be coming sooner than thought? First, I got to demystify the term break-even inflation rates, as they're commonly thought to be market-based inflation expectations and often cited in the media writ large. The break-even rate is simply the difference between the nominal yield and the real yield on an inflation-linked investment of similar maturity. So, for example, the 10-year U.S. Treasury minus the yield on the 10-year Treasury inflation-protected securities, also known as TIPS. I realize nobody said there'd be math involved, but you got to bear with me. The 10-year Treasury is currently approximately 1.3%, 130 basis points. And the 10-year TIPS, i.e. real inflation-adjusted yield, is a negative 80 basis point, which is up from the recent local historical low of minus 110 basis points. So, here's the math. 130 basis points minus a negative 80 gives you a 210 basis point break-even spread. So the market-based expectation is then said to be above the Fed's new average inflation target of 200 basis points, 2%. But for those who are not yet asleep, here's where it gets interesting. The Fed is not only not behind the curve, and these alleged market-based inflation expectations are extremely misleading. And here's why. The Fed is nearly single-handedly causing market-based break-even inflation spread to rise, giving the impression of, wait for it, inflation. As part of the quantitative easing program, which was reintroduced in response to the economic impact of the 2020 pandemic, the Fed is currently buying about $120 billion of bonds per month, $80 billion in treasuries, which includes TIPS, along with another $40 billion in mortgage-backed securities. They are doing this in effort to get inflation up and keep mortgage rates down. You should also note the following. The Fed now owns 25% of the entire TIPS market. That's up from about 15% about 12 months ago. This, as the TIPS market, as a percentage of the overall Treasury debt, has declined to now less than 7.5%. Said differently, the Fed's buying more of something which there is less of. So, declaring signal from this noise is increasingly deceptive. To say nothing of the fact the Fed has in the past written about flaws in the TIPS and the break-evens. They've detailed the lack of liquidity in the TIPS market as problematic, saying, and I quote, "The spread between the yield on a nominal Treasury security and that on a Treasury inflation-protected security, TIPS, of comparable maturities, usually called the break-even rate of inflation or inflation compensation, has often been used as a real-time proxy for market participants' inflation expectations. However, policymakers and market participants are also cognizant that this spread is an imperfect measure, as it contains other components that drive a wedge between inflation compensation and market participants' true inflation expectations. The Fed does not advertise this and surely doesn't want us considering it or other obvious impacts and various correlations which we all know exist. Break-evens and the S&P remain quite positively correlated. So the Fed remains a large driver of stock prices. Think K-shaped recovery and a wider wealth gap, despite what they say. The correlation between break-evens and oil is also very strong. Think about that the next time you fill up on your way to work, provided you still have a job and an income. You're considered one of the lucky ones, and so on. In conclusion, when you hear anyone anywhere suggesting rates are going higher and the market-based inflation expectations offer any value in determining the future of rate hikes, kindly dial up your favorite Etico Partners financial advisor to help distinguish the noise from the signal. And for more insight on how all of this impacts your specific situation. Stay tuned till next time.